Welcome back to the Cash Monies channels. Before we go on, please do not listen to a guy that's going to talk to you right now using his kid's chalkboard. If you learn something and you use it and you get cash, then that'll be great. I'm going to talk about when you have money to invest, when should you utilize that money to invest in stocks or indexes. And I'm going to show you the different types of charts. So if you are either a single stock investor or index investor, so the most easier one, or probably the more simple one, is if you're going to be an index investor. So you're going to usually, the best indexes usually for the past 10 years is growth indexes, or indexes that follow the S&P 500, which is the S&P 500 just means the top 500 companies in the USA, and also the total market index. And total market index is just all the stocks around the world. So I'm going to just show you usually the S&P 500 and the NASDAQ. They're usually like something like that. A lifetime of its chart. It's always trending up. So when you buy an index, you're buying at one of these points, and you're just riding it up until retirement. So the S&P 500, it follows the top 500 companies. So if the top 500 companies are doing well, you're going to do well in the index. If you're in a growth index, it follows all the big tech companies. If the tech companies are doing great, like Microsoft, Facebook, Amazon, if they're all doing great, your index is going to be doing great. So usually when people have money, they just want to know, when do you put that money in to invest to make money? An index is fairly simple. If you dollar cost average, you're gonna be making money no matter what if you hold it long term. But maybe some little tips to get ahead of just the average investor is maybe investing on red days. Red days just basically means when the market is trading in the negative. There's more sellers than buyers. So during the dips, so if we zoom in, probably like on this area here, the graph's gonna look like this, and then it's gonna dip like that and go back up. So on the red day, you wouldn't want to buy here. So when you buy here at this price point, you're gonna have a higher return. So basically, as it increases, your total portfolio is going to increase. And so buying on more red days is usually a better strategy. Or you could dollar cost average too if you don't want to worry about it. But usually what I've done is I've used my HSA, and anytime there's a big red day, usually negative 100, 200 to even 500 points, then I put some of my money in my HSA, and it's a health savings account. Once it reaches $2,000, you can invest in stocks and indexes. I take that money and put it in an index. And so any red day, so as it recovers, then I get more money, versus the person who just dollar cost averages and buys like at the highest point, because these people won't make as much money as these people when they invest. So they'll just get this margin here versus this margin there. So this is a big gap here that they're getting more money from the market. All right, and so basically I want to talk to you. Looking at charts is more for single stock investors, whether you're long or you're short. If you're a long investor in a single stock, you just want to buy the uptrend. So if a stock is uptrending, it's going in an upward direction. So it might look like this, but it's always moving up. It might have some dips, but it's always moving upwards. These are the easiest charts if companies have this look to it. It might change later down the road, but if it has this trajectory, it's easier to make money. So what's another good way to make money is if you buy the dips. Say It's just like the indexes that I was talking about earlier, but if you buy here, and then this area here, right here, this might take could take a couple days, could take a day. I mean, it happened to me before I bought here. Next day, went back and recovered. You get 8-10% easily on your money that you invested here. Or it might take maybe a month, 2 months. That's basically a swing trade. So that's basically what I do. So you just want to buy low, sell high. And there's a lot more, we could go more in depth on it because there's a lot more. In this area here is a question of when do you buy. So there's a lot more things to discuss later on. If you're interested, just let me know in the comments below. And then there's also sideways dips you could buy. So if a stock looks like this during a certain period of time, you could look at the daily charts, the monthly charts, 10-day chart, 20-day charts, or a yearly chart for the company that you're interested in. But usually, if it looks like this in their 3 or 6 month chart, this is called the box formation, okay? And usually, it's going to stay within this box. Unless there's big news, something happens, then it could either dip or rise. Maybe they acquired a company and they're gonna increase their forecast of revenue. So basically, what you do is you wait for the dip, and then you wait to sell off at the top. And usually you find your price target at the bottom, and usually this is called the support line. So when a chart dips, it's going to hit the support line, bounce up to this line here. That line is called the resistance line. So it's going to hit it and bounce back, hit it, bounce back. So you buy, sell. And you could probably do that for a couple cycles before the chart pattern changes. So that's another way to make money in the stock market. And these are just all basic charts too. There's more complex charts than this. And then you could also buy, a good time to buy is when there's stock analysts increase the price target of your company. And you don't always trust the stock analysts though, because they might have an agenda. There might be a hedge fund that says stock price is really low, everyone sells out, and then the hedge fund buys it, and then it goes back up again. The hedge fund sells out, it takes that profit from the retail investors. So just keep that in the back of your mind. And also another easy way to invest in a company and make more money is choose companies that are strong companies, like they have good fundamentals. They're in the S&P 500 index. As long as the chart looks great, they have strong fundamentals. Look at their revenue; they're making yearly gains. I mean, you shouldn't have anything to worry about. But you know, that's just maybe. Just keep that in your mind. It could always drop, like like what happened in February. And so, basically, what you want to avoid though is a downtrend. So, if the chart of the stock is downtrending, this is for more advanced short sellers. A short seller could make money because if you zoom in here, it might look like this, like something like that. But it's still going in a downward trend. But they would buy here, sell here, but buy here, sell it. But it will always get lower and lower. Basically, the sellers are selling at a lower price, and the buyers are buying at a lower price. And basically, I don't invest in penny stocks. Probably like 90% of people who invest in penny stocks lose money. Only 10% gain money. And dips that haven't recovered, sometimes it may dip and go flat. I mean, so you probably wouldn't want to invest. You want to wait for some sort of momentum upwards, back upwards. And then also avoid hype, like the EV hype. Sometimes it's good, sometimes it's bad, but you don't know when the hype is going to end. So always try to avoid that. And then also stocks that are going bankrupt. I wouldn't invest in that. I have made money off of a stock that is getting close to bankruptcy, but I could talk about that later if you're interested. And stocks you don't understand. I mean, if you don't understand genomic stocks or pharmaceutical company stocks, I wouldn't invest in it. Just find stocks that you believe in, that you use every day, and then you can look into those charts, look into those companies, and if they resonate strongly with you, then you can go ahead and invest in those. And commodities. I don't invest in commodities. They don't usually follow. They do follow some patterns, but they're a little bit more advanced, and they're more volatile. And also try to avoid companies with high PE ratios. Usually that means their price is higher than their profit over earnings. So usually they have a high PE ratio. Eventually they'll come back down. Except for growth companies, they usually have higher PE ratios, like Tesla or Google or something like that. But Tesla's right now they think that they're really overvalued, but a lot of people don't think a lot of people think it'll get higher. And also stocks with low volume, like penny stocks, they have low volume. Not a lot of traders selling, so it's harder if you want to buy it. You buy it. It's harder to buy and harder to sell at the price you want. And some good box patterns that you could look at is like at home, Netflix, Amazon. Those have good box patterns. They're just trading sideways. And just know when to take your profits and cut your losses. You could always set a stop loss. So if it dips below the price that you bought at, it'll sell it to minimize your losses. But if you have any other questions or comments, put it down in the comments below. Like and subscribe, and you guys have a great day. All right, thank you. Bye.